Good morning and welcome to the latest Development Finance Today virtual roundtable. Since February, we have been running these on a weekly basis with the purpose of exploring subjects that matter to the lending and broking communities and which impact all stakeholders. My name is Caron Schreuder and I'm the Managing Director of Medianett, publisher of Bridging and Commercial and Development Finance Today. And for this morning's live session, we have partnered with specialist property lender Acre Lane Capital. I'd like to extend a warm welcome to Ian Wilson and Chris Pigden from Acre Lane, as well as our expert panel of brokers who will shortly introduce themselves. Thank you very much to our panel for spending this hour with us and sharing your knowledge of the product. And thank you to our viewers for tuning in. Please be reminded that you can ask questions throughout the session using the option on your audience dashboard, and we will try to get to as many of these as possible. Our topic for today is development exit finance. It's been widely reported that the past year and a bit has been incredibly tough for developers and their schemes as COVID wreaked havoc on the property and construction sectors. Its effects linger on. Materials availability, labour shortages, social distancing, planning bottlenecks, and an unpredictable sales environment remain burdensome for those trying to complete their projects. Brexit is also a factor that looms, with its full impact on the market yet to be determined. Positively, development lenders have of late come out in force to support these borrowers with new funding, rate reductions, and innovative product offerings. One such offering is development exit finance, a loan that effectively allows a developer to refinance their existing loan at one of various stages in their project. This has several benefits, not least of which is the ability for developers to unlock cash which is invested in overrun schemes to move on to the next. Cash flow has been a huge concern for developers in 2020 and into this year, and any opportunity to leverage the equity that they have is something to be embraced. In a volatile economic environment, it's pertinent for brokers to keep an eye on options such as development exit finance to protect their clients from the kind of disruption that we faced at the start of the pandemic, with some lenders stopping drawdowns. In addition, this type of loan anticipates the very real possibility of increased interest rates in the event that a scheme is delayed. In Ian's own words, considering this early puts developers in a position where they are more in control. Today, we will be covering the costs of these loans, when and for whom they are suitable, the various iterations of this product. Acre Lane has recently launched a suite of 3, and how brokers are finding that it works in practice for their clients. I would now like to ask the panel to introduce themselves, and we will start with Chris, please.
Hi, my name is Chris Pigden. I'm Managing Director of Acre Lane Capital, and my principal role is in Head of Risk and Head of Underwriting.
George?
Good morning, my name is George Eleftheriou. I'm Managing Director of Real Finance. We're a small team of 9 in our business. We're all ex-bankers ourselves, myself. 27 years in banking prior to setting up this business 4 years ago. And we look across the range of commercial finance solutions for our clients. There's obviously a big amount of development finance and development exit finance we do for clients, as well as other things outside of property.
Ian?
My name is Ian Wilson and I'm CEO of Acre Lane Capital. We're a lender that lends across bridge loans, development loans, and development exit finance, which is what we're here to talk about today, where the underlying collateral is always, certainly at the end of the loan, residential.
Thanks, Ian. Kevin?
Hi, good morning. My name's Kevin Gillam. I'm a director of City Finance Brokers. I've been a broker now for sort of 30 plus years, so have a sort of very wide and extensive experience. Again, in the last probably 10 years, my speciality has really been development exit finance, commercial finance. So effectively means I have quite an extensive knowledge in this particular area of the market.
Thank you, Kevin. And we've got James on audio. James, would you like to introduce yourself?
Yes, hi, I'm James Lennon, Director of Tapton Capital. We're a small team of 5, specialised predominantly in short-term funding, development finance, with a little bit of sort of buy-to-let and commercial as well. Yeah, and we're a small team, but growing, do a lot of development finance and a lot of development exit. So yeah, looking forward to having a chat about it today.
Fantastic. Thank you very much for that. So we'll just launch into our first part of the discussion, which is talking about the macro development finance market and property market, because this is a product that's born out of a lot of things that are happening in that wider space. We certainly want to be quite specific with the rest of our conversation today, but I think it's definitely makes sense to set the scene and put into context the surge in requirement for development exit finance. So Ian, I'd very much like to start with you to give us a little bit of a background or backdrop to this.
Sure. I think over the last year and a half, we've seen a significant growth in development finance loans, which of course some of those lead into development exit loans, whether they've been written by ourselves or written by other people initially. The challenge has been, I think, twofold in terms of exiting development finance loans. One is that pandemic hit, as you very precisely just mentioned, articulated, and that clearly the shortage of labour and materials has definitely lengthened the time for build, and we've seen that across our own development finance loans. We've largely dealt with it by extension, rather than by requesting borrowers exit the loan. The reality is our preference is to extend, if the risk is acceptable, and largely we in nearly all cases we've extended loans, and I don't think that I don't see any of these loans as risky loans. It was just something that we've done. We'd rather keep the loans that we have rather than force people into an exit at this point, given that we don't believe that they are risky in the current environment. However, I think there have been a lot of, the other reason why I suspect we're seeing a lot of development exit loans now is some people perhaps have taken a slightly different tack in terms of, particularly if they've got bank lines. I think there's less flexibility for those lenders in terms of extending. And as a consequence, we've definitely seen a number of, a whole host of opportunities. We've never seen as much volume as we are now. Some days I have to pinch myself and I wonder whether it's luck or skill or just the market. I think I've concluded that the reality is we've broadened our product range dramatically, and also increased the notionals that we can notional of loans that we can lend to, and also increased our maturity beyond 1 year, which historically we weren't able to do. So the combination of all of those things, I suspect, is what the reason, rather than luck, that we've managed to broaden the amount of, or see a lot more business than and write a lot more business than we've historically been able to. And I think the other problem is, I suspect that a number of lenders tend to shorten the length of the loan that they're offering in order to increase the upfront, particularly for small developers who perhaps are looking for more of an upfront contribution than perhaps the loan should be able to bear. and clearly the way to do that is to shorten the term, therefore reduce the interest, and therefore bring whatever constraints they're up against in terms of the modelling into line. I think that's probably it for the moment.
Kevin, coming over to you from a broker perspective, do you echo Ian's thoughts? What are you seeing on the coalface?
To be honest, I 100% agree with everything he said. I think that I've enjoyed working with Acre Lane recently in terms of their sort of pragmatic approach to certainly not. When you talk about development, I kind of split it into two categories. Most lenders will only lend once the developers reach PC, which often, or certainly in the current last 12 to 18 months, most developers haven't reached PC because they've been delayed by the pandemic and all of the associated issues with that. So lenders that are in the genuine finish and exit market, which Acre Lane are, I think is much more helpful. And I agree. You know, we've had shortage of labour and materials, and you know, and a lot of other lenders being much less flexible with their developers and preferring not to extend and to deem what I would consider most of these deals to actually be in a better position than they were when they actually originally funded the deal, but taking the view that they're not in a better position and they want their loans repaid, and doing it in a quite aggressive manner, which I think is a bit unfortunate. But again, perhaps that's because of the way some of these lenders are funded.
James, just coming to you, you do a lot of work of this ilk. What are you experiencing similar attitudes from development lenders, and how much of this business are you doing right now?
Yeah, so I think, you know, it's stereotypically people will go for a 12-month of development term with a 6-month sales term, and I think it's usually the optimism bias of the developer which sort of gets the lender to agree to that. You know, any delays in sales or any delays in starting the build, cost overruns, means that it inevitably goes past that point. And I think, you know, some lenders will extend, some don't want to extend, and so I think, you know, the ability for developers to have an option to go to, which sometimes is cheaper than the current finance they're on, is a good sort of saving grace. And I think, you know, as well as, you know, cost overruns, labour shortages, I think with the rates that you're now seeing in development exit finance, it might just become a viable exit route for people to go down, just to be on a cheaper facility whilst the sales go through.
Chris, is there anything you'd like to add to this initial part of the conversation in terms of what's fueling demand for development exit finance?
I'm always somewhat perplexed by the reasons why existing lenders don't want to carry on with the loan. The way we do it at Acre Lane is really have a holistic view of the risk. Each risk is idiosyncratic, but it seems to me that, and by and large, by the time these developments are rolling around to us, they are somewhat finished. They're at least wind and watertight mostly. Some are, you know, a couple of months away from PC. It seems to me that it's a basic refurb loan in risk terms. So I don't really understand why existing lenders are so reluctant to extend. So we just look at the risk as it's presented, where the execution risk that's left in the loan, the build risk is low. We don't need it to be at PC, so I must admit we are somewhat bemused by the reluctance of others to carry on with loans. We don't really get it. We look at it, as I say, holistically as a risk. What are the remaining risks? Are they acceptable? Are they within the? Can we nail them down with a degree of certainty? Which is why we puts our favourite monitoring surveyors straight in it, say, right, what is the cost to complete, what are the hazards, and do it that way. But yeah, somewhat bemused, I must admit.
Just on that, if I can just add one more thing. You know, development exit in most people's parlance is generally when properties are at PC. The reality is we've been doing the majority of development exits we've been doing are before PC, and you know, you mentioned that there were 3 products that that Acre Lane have devised. I mean, the reality is there's one product, but the one product allows exit from DPC being achieved, i.e. foundations in, all the way through to at PC, and we can do a development exit loan from any point after DPC. And we've seen and completed a very significant number of loans which, for whatever reason, have got to the point where they're DPC through to PC, and the lender has pulled out. And we haven't, you know, to date, and I'm not saying that that will always be the case, but we haven't run into any problems whatsoever that were as a result. We've run into problems, let's not beat around the bush. We've run into problems, but not as a result of taking on the project before PC. You know, and it's for us, it's something we're very comfortable with. We've done multitude of times now, and actually intellectually it's a bit more interesting as well. So you know, we like them.
Okay, thank you. George, I'd like to come over to you to start with, I suppose, a little bit more of the nitty-gritty about this product and how exactly it works from the point when you have a developer client for whom you think this might be suitable. What are your first steps? We'll obviously talk to Acre Lane about exactly how they underwrite these and approach them, but from a broker's point of view, how do you approach this?
Sure. I mean, I think if we use this scenario of PC, I recognise that Acre Lane will come in a lot earlier in the process. But I guess even earlier in the point, you would look at what the cost of complete is. If it is completed, ultimately, the first thing I want to understand is what are the reasons that the client wants the development exit. Is it because the lender's pulling out or no longer wishes to support? Is it because the lender's funding lines are at maximum, and in order to unlock the next development, they need that loan repaying, in which case it makes abundant sense for them to move it. The other thing is, sometimes, I mean, we can look at it in terms of a defensive move by the client because they need to move it over and have an opportunity to sell. But for a lot of them, especially in this current market, it's a positive move. Actually getting another 6 months facility, 12 months facility may well be a way in which they can use the extra time to maximize their GDV. You know, I want to hold on for a little bit more money. Obviously, you need to do the maths on that and ensure that you don't just hang on for the best price, recognizing the cost of finance over time could erode that profit. So it's a real balance of views there, just to try and understand, well, at what point is it the right time to accept an offer. So I do often ask the client, well, what is it that you're seeking to achieve? How long do you want it for? And you also understand the cost of doing so and that impact on your project, because of course you can look at it at the beginning of development and see, well, this is how much profit I'm going to make. But ultimately, when you get to this point, this is the nitty-gritty. This is the point at which you're really going to unlock the value in your scheme. So that's quite crucial. And then from my perspective, the next thing I'm really wanting to understand is which lenders are really going to get this, understand it. Yes, cost is a consideration, but also flexibility in the facility. Some clients prefer to, on sale of a property, prefer to repay the loan as quickly as they possibly can, leaving the residual properties for them unencumbered, so they can decide on what they want to do. Others want to be able to repay a proportion of the net sale proceeds and keep the facility rolling as long as they can. So different lenders will approach that in a different way.
Caron, can I just come in at that point? One of the other things we tend to find is that a lot of developers, particularly as they are nearing the PC side of things, want some sort of takeout. That's another function of the development loan, is that they want some extra slug of money to come out at the point where they refinance, if I can, at that point. And I think most development lenders are sort of 50-50 about this kind of thing. We take the view that it is something that we will look at. It's actually something we're thinking of embedding in our actual development loans, is that when something reaches PC, we will automatically provide a borrower with the ability to take out some money. The reason they usually want that money is they've now found their next thing, and they want some slug of money to stick down on the next thing. So they've got that, they've got their development happening here, they've got another one that they want to do, and they want to roll on their crew to the next one, and so on. And what we are trying to do, what we are definitely looking at, is embedding that ability to have a slug of money coming out when we reach PC. Our usual constraint, as with most development lenders, is something to do with loan to cost, not loan to GDV. So a typical development loan might be something like 80% loan to cost and 60% loan to GDV. And we always get the same thing. Well, why can't you do more against when you're only at 60% loan to GDV? Can't you do 65 or 70 or something like that? Our usual constraint, as with most development lenders, is loan to cost. And that's the tail that wags the dog, always, always, always. So what we're saying is, at the point where you get to PC, a lot of your all of your execution risk is now done. You've really got the market risk of what these properties are valued at, and the liquidity of them, and the ability to sell them, and so on and so forth, which is fine. So what we are now saying in those development loans is that we are happy to, instead of it being 85% loan to cost, we will actually look at this and say, well, what does this look like at something like 95 or 100% loan to cost? And that usually means that 60% loan to GDV is now more like 70% loan to GDV, and we are looking at allowing that slug of cash to come out at that milestone. So that's so we are definitely finding that developers are far more interested in that extra slug of cash at the end, rather than necessarily a development finance exit, a development exit product, which essentially is finished products, finished houses, means that we should be looking more at a lower rate of interest, something that's closer to something like a bridge rate of interest, which is typically a couple of percent lower than, a good 2% lower than the typical development finance rates. But for a lot of, like I say, for a lot of developers, they are more interested in the slug of cash they can get out than the actual development finance rate being lower. It's the money they want. It's to move on to the next thing is far more important to them.
Kevin, does that sound like something your clients would favor? This idea of structuring a deal in a way that they can extract the cash out, because we know this is a common use of the product, but being able to do it almost automatically, does that sound attractive to you?
I think it sounds very attractive. I think it's most of my developer clients, I would say, are serial entrepreneurs, and nothing frustrates them more than missing what they perceive to be a great opportunity to secure, the next potential project or two potential projects, and that so often is down to cash flow. Increasingly over the last, again, 2-3 years, something that's significantly hampered this whole scenario is the speed at which buyers, assuming the developer is selling into the UK residential market, whether it be on government assisted schemes or buy-to-lets or whatever, the time duration from a residential or a buy-to-let application through to them actually being able to complete on the transaction has just increased several-fold. Obviously, the whole stamp duty incentive has probably impacted on that and made things much worse as well. And equally, you know, the impact has rolled across to delays with surveys, and also delays with conveyances, because again, a lot of those kind of buyers tend to use very much bog standard conveyances that are recommended by the mortgage lender because they will do the transaction for a cheap fixed price, but they also tend to be inundated, and so they're incredibly slow and inefficient. So that entire situation has a knock-on effect to the developer, and of course means that he has the frustration of having reached PC on the site and have potentially several £1 million worth of equity tied up in that site, which it's not very easy for him to get his hands on unless a lender's prepared to take a pragmatic approach, which again, unfortunately, you know, many lenders aren't. And so kind of hearing this from Acre Lane, I'm not actually hearing it from many other lenders out there. So that again is a significant positive, and I think very attractive, certainly to the developers that I'm working with.
Well, our viewers heard it here first, so I think we'll look forward to seeing that from you. James, just coming to you.
Sorry,
yes.
sorry, apologies. Sorry, no, go to James.
I actually just wanted to quickly cover off with James the something that Kevin's touched on about general lender appetite for this type of lending. Naturally, Acre Lane is kind of cleaning up in this area for a reason. But James, can you talk a bit about sort of what's available in the lending landscape for development exit finance, whether there's enough, if you expect that to rise?
Sure. Well, I think, you know, it's a fairly new term that's been coined. I mean, ultimately, it is just a bridging loan against a finished development. But I think lots of other lenders have now sort of come to the market with a development exit product, varying rates, varying degrees of flexibility. But I think it's becoming something that is quite popular. But again, it's just sort of down to the flexibility of the lender. I recently had a case, and we've approached several lenders, and the one that the borrower chose to go with wasn't the cheapest. It was the one that allowed him to keep some of the sale proceeds. Provided the first 2 units had sold, he was then allowed to keep 25% of the sales proceeds. The lender was happy because he had 9 out of 11 already sold and agreed, and of course they then get to keep their loan out for longer. So I think there's a lot of competition in the market now with development exit, and I think that you know, who comes out on top isn't going to be driven solely by rate, but also flexibility.
Seems to be a common theme across just specialist finance in general, that the rate is now no longer always the deciding factor, which I think is quite positive. Ian, you were going to say before we launched into James.
Yeah, I was just going to go on and say further to Chris's comment. You know, the other advantage of adding the development exit loan onto the development finance loan, so basically you're blending the two products. I mean, the result is the same as if they'd just come to us at the end of the development finance loan and asked for an development exit loan, except for the fact there's one set of fees, one set of docs, and certainty at inception that you are going to get a development exit period, and you still get paid out, you know, paid out at PC in terms of the uplift from the LTGDV from the development finance loan through to the development exit, and I think certainty, for me, I can't understand why everyone doesn't want certainty, because you don't have, if you've paid off the loan, you've paid off the loan. It's not like you have to use it. But why wouldn't you want to be hedged against a changing market. I mean, everything looks rosy from a sales perspective at the moment, but particularly people entering into a 12 months, 18 months, 36-month build schedule, who knows what it's going to look like? I don't even know what it's going to look like in 18 months, never mind 36 months. So for me, it's kind of a no-brainer that that people should move on to a product that provides the flexibility to do the development finance loan with an extended period of development exit loan attached.
George, I just wanted to come to you to ask about whether there are schemes or borrowers for whom this would not be an option, and when and why this might be the case.
I think generally it's hard to envisage a scenario where generally it is not. I think if you're at the point where actually they're bang up against their leverage, so back to Chris's point around the loan to cost is very high, and additional finance costs beyond the development finance facility may well start to threaten the return on the project. So one should never see this as a product of last resort. As I said earlier, it's not necessarily always a defensive product. It can be used in more positive ways. But there will be scenarios where a client really needs to get out of it pretty soon because their costs have been, they've either gone to such a cost overrun that actually the only exit is to get a quick exit and repay the loan as quickly as they possibly can, even if it means a potential fire sale. Hard as it is sometimes to tell a client that, occasionally that might be the right answer. Very rare though.
Chris, is there anything you'd like to add to that about, I guess, borrower viability for this product?
No, I think it's incredibly flexible. I mean, it's not just you also have the scenario where you may well have a slice of very expensive mezz sitting behind you. So the equity, if I can call it equity release, it's not. I'll call it equity release. Hey, that's kind of what it is. We certainly have a lot of people who are under pressure. A lot of the reason why people want to keep a percentage of their proceeds, as James has alluded to, is often, well, yes, they may well be moving on to another site, but often it is also because they've got some expensive mezz sitting behind them, and they're paying out 18-20% on something, and they need to get rid of it super duper quick. So equity release plays into that as well. Here's an extra, we go from 60 to 70%, we release a slug of money and bang, out you go. That you've got the guy who's funding the 85 to 95% loan to cost slice, and you can take him out. So that's another use of it.
If I may, I've got a question here from the audience, which I think I'll pass on to Ian. The question is, could you explain further why there is such a restriction on the LTC metric? Is this to ensure that there is skin in the game from the developer? How is the LTC calculated? And is this the total cost to include all finance costs or just land and build?
Sorry, I was on mute there. Chris, jump in if you want to answer any of that. I mean, LTC is, in some ways, the way we look at it is, LTC is a relevant constraint during the life of the project. If there is a worst case scenario and the project doesn't get completed before we're looking to exit, and if there's a fire sale of the site, then the reason why LTC is relevant is we know what the costs are. The costs are determined by the purchase price of the site and the build cost to date, and we would like our loan to be a fraction of those costs, and typically we're lending at anywhere from 80 to 85 or 90, depending on the quality of the borrower and the liquidity of the underlying, etc., etc. and that gives us between a 10 and 20% buffer from costs, and we believe on average we should be able to sell the site at cost or thereabouts. Hence we have a buffer which is effectively defined by the LTC calculation. The person answering the question is also right in the sense that we're interested in skin in the game. That said, skin in the game gets very muddied these days with mezzanine lenders being, so many deals being supported by mezzanine lenders, etc., etc. I don't say that on a negative basis. I only say it obviously reduces the skin in the game for the actual developer. And we do like skin in the game from the actual developer, but we recognize, particularly as we go up the spectrum in size, that it's unrealistic to expect developers to be putting, millions upon millions in, and therefore, requires a mezz lender to basically bridge the gap between where we're lending on a senior basis and where the develop, how much money the developer can realistically put in.
Thank you for that, Ian. James, you mentioned earlier you likened this product to bridging in some ways, and much like bridging, it's becoming more of a product that's considered at the outset of a deal rather than as an emergency measure or something that's considered during it. Is this the case with? I know Ian is definitely an advocate for considering development exit finance earlier. Is this something that you would agree with?
Absolutely, yeah, for several reasons. First being that when you tend to take out a development loan, if you put in a, say, 12-month term, for example, it'll decrease the net loan that you'll get on day one. So a lot of developers are reluctant to do that. Secondly, if you're gearing up to, say, 70% loan to GDV, like a lot of developers do, the interest rates that you're paying are typically much more expensive, or can be much more expensive rather, than development exit rates. So if you can factor in getting your development to practical completion there or thereabouts, and then being able to refinance on a sales facility at a much cheaper rate of interest, your overall cost of interest across two lenders throughout the whole project can actually be much less than if you'd have just stuck with one.
George, is there anything you'd like to add to that in terms of the way that these deals are being structured and the benefits of considering this product ahead of time?
Yeah, I mean, as ever, I think the sooner you consider what your options are, even during a development, the better. It gives you more options, and I guess it helps you sleep at night if you know that you've got, whether you call it a plan B or an alternative exit beyond the natural sales cycle. Is clearly going to be advantageous to all parties. I mean, picking up something James said right at the beginning, at the moment you see a lot of structures on development finance, which is 12 months build and 6 months sales. Clearly, we're now coming. If you look at that logically, that means we're now starting to see exits on facilities which would have drawn at the beginning of last year, pre-pandemic. So in many ways, those things ought to have been talked about at the beginning of the year in terms of development exits. But we're starting to see now clients certainly starting to talk to us at the 6 or 9 month part of their developments and starting to understand, well, look, we're getting some reservations. That's a really good sign. Perhaps we need to start talking to our existing financier as to whether they would consider a sales exit or whether we need to look at an alternative lender, because clearly if you're going to segue into a facility with the existing lender, it's a much more straightforward process in theory than starting again with somebody else. But clearly if the development lender is not supportive, what we said right at the beginning, you really are going to have to start thinking a good 6-8 months ahead in terms of sourcing the right lender, the one that actually delivers what it is that you're looking for the period of time that you're looking for, pricing, of course, James talked about just now. And so you can get all of those things lined up in good time ahead of a development lender saying, oh, can I have my money back, please? So it is quite important to get that very, very ahead of the game.
Thanks, George. Kevin, I just have a question. It's slightly off script, but hopefully you can help me about the relationship between the original development lender and then the lender who's offering the exit finance. Does that always run smoothly, or are there sometimes issues with the transfer of that loan?
No, I wouldn't say that it always runs smoothly, because ideally you would try and retain the finance with the original lender, and usually what's happening is the developer's usually either approaching the point at which he should have been repaying the loan, and often relations between him and the existing lender are often quite strained. And you know, we as brokers are put under a lot of pressure to try and find the developer a quick and efficient exit, so that the client doesn't end up incurring, you know, quite horrendous penalties from some of these lenders who, you know, seem to take a very you know, can sometimes take a very aggressive approach, and a lot of them have you know, a very sort of penal sort of penalty if you don't actually repay within the time constraints of the original contract. So it puts a lot of pressure on everyone, including broker, developer, and new lender, to actually potentially hit a very tight deadline to ensure that the client actually doesn't incur all of these horrendous penalties that are on the table. And you'll often find that the current lender are offering very little flexibility, and frankly, if the deadline isn't hit or very close to being hit, that they will apply the penalties as per contract, which is very unfortunate. So yeah, these things don't always go smoothly, I have to say.
Perhaps a topic for another roundtable, but yes, Ian, how do you smooth that?
Well, no, I was just going to say, in terms of going back to a point that Chris made right at the beginning, you know, I'm just thankful that we actually don't use bank lines as an example, because they do tend to restrict action that you can and cannot take. The main funder that we use is, you know, highly flexible and looks at risk in the same way as we look at risk, which is holistically. It doesn't matter what's gone on in the past. It doesn't matter that, you know, it doesn't matter that one constraint might be out of sync with the others. We look at the holistic risk and take a view on that holistic risk, or the risk in the round, the totality of it. And you know, you often find that you look at one or two constraints, you think, oh, that doesn't work. Well, but when you take it as a whole, it does work.
Thank you for that, Ian. Chris, can we dive into the three variations of the products that Acre Lane offers, and what the difference is between the three, how they differ from an underwriting perspective, anything that our viewers may need to know about what to consider at each stage?
You're on mute, Chris.
Thanks, Ian.
Easy to forget, isn't it? I mean, they are just basically different stages of the development process. So the way I look at it, it doesn't really differ from the process. The underwriting process is the same. It's really evaluating what the cost to complete is and what the hazards are around cost to complete. You know, getting up to DPC level, you've got rid of the out of the ground risk. Now, a lot of lenders would say, well, that is the principal risk. It really is about, once you're out of the ground, you're up to DPC level. You're really looking at a much more controllable execution risk. Obviously, when it's wind and watertight, again, you've taken out a level of execution risk. So you're really talking about the ability to, I always say with these things, it's about can the builder build in full, on time, on budget. If you can do those three, happy days. So it's the ability, it's the constraint around each of these products is how that is compromised. Now, if you've got a fellow who's got to put up a timber frame, or he's got elevators that he's buying with forward funding and so on and so forth. I mean, all these other things come into the mix, but essentially the intellectual process is the same. Usually what we do to try and make sure we get a handle around this is it's important to understand the history of that particular site when we're taking it over in the middle. 9 times out of 10, what that means is that we are usually going to the same monitoring surveyor that is being used already. I think we're relatively unusual amongst lenders in that we don't have a panel. People talk about panels. What are these damn panels? I've never seen them. I don't know what they are. We don't have a panel for valuers. We don't have a panel for monitoring surveyors. So we are not constrained by saying it has to be this or it has to be that person. So 9 times out of 10, we will use the existing monitoring surveyor, and we will want to see the existing monitoring surveys, and we will make an evaluation. Most of the time they are people that we know. Or have used before ourselves, but I always focus very much on what is the monitoring surveying saying, where are the risks in this site, and you can see them in black and white, or in the case of monitoring surveyors, it's usually red, amber and green items which tell you exactly where the problems are. So like I say, intellectually it's not a different process from each stage. It's just about, can they build from where they are now in full, on budget, on time, from now.
I imagine that at the moment that is made quite difficult, as with any lender right now, given the circumstances that we're in, albeit we're coming out of those. What sort of additional... That's why I say from
now, because we can talk about why they're where they are right now, but builder went bankrupt. Is one that's doing which is always a hazard, but is particularly a hazard at the moment because their cash flow has been skewed out by lots and lots of things. So it's from now. That's the point. We freeze it where we are. Where are we now? What are the costs to complete? How long is it going to take? How much variation of what's the bell curve around the probability of that being able to be executed in full, on budget, on time? If it's reasonable and we can get our heads around it, and it really is about, all right, well, you've got 3 months of finishing off to do, you're wind and watertight, you're now going into second fix in earnest. I can get my head around that. That's a refurb loan, right? Doesn't matter where we got to, why we're here. I mean, it might be relevant. We have to look at that monitoring report and see what have been the problems on the site, and are they ones that are going to be going forward problems for the site? But if they're not, and it's just a case of, as we've mentioned before, about the existing lender taking a certain kind of view, doesn't like the exit, doesn't like the length of time, wants to enforce, whatever it may be, it's just not the way we look at it. We look at it from where it is now. That's the important thing.
Thank you for that, Chris. I just wanted to touch quickly on it's something that comes up a fair bit with development finance at the moment, and what a developer should reasonably expect from their finance team and the questions that should be asked. And I wanted to ask our brokers, perhaps Kevin, you can kind of share with us the sorts of questions, communication that's happening right at the outset with your developer clients to ensure that they're as supported as they can be, whether it's with this product, whether it's with another specialist offering that can see them through. What sort of advice do you have?
I think every developer works slightly differently, and I think some larger developers obviously have larger teams around them in terms of bringing all of the relevant documentation together for the prospective lender as soon as possible. Most of my clients are, I would say, kind of medium-sized developers, so they have decent teams around them, which means that more often than not, we can provide a pretty comprehensive pack for a lender day one that will cover off all of the due diligence requirements that they're likely to need, which tends to mean that we can tend to expedite things relatively quickly. Often development sites will have been purchased on a bridge to start with, so it often means that there's already an existing survey report that can be scrutinised by the lender. It obviously may be sort of over 6 months old, so it may need updating to bring it up to date. Obviously, some of these sites were purchased with planning, some without planning, so sometimes there's a significant planning gain for the developer, or even perhaps an amendment to the original planning, which is something they played around with whilst we get all the ducks in a row ready for development funding. But I think what we try and do is as I say, is put a fairly comprehensive package together day one for the lender, so they have all of the information they need to make a good assessment of the project and whether it's something they feel that that they can fund and we can move forward on relatively quickly. I think, again, what's happened over the last 12 months of pandemic is, of course, everything in the whole process has been delayed. So, not just with shortages of building materials, but subbies on and off of site because of COVID, which is a much more torturous process than you might imagine sometimes, because you can have people literally bouncing on and off a site as they get told they have to by track and trace. Material shortages have been an issue and delayed things, and of course getting planning through from local authorities has been a historic issue for forever. So as you can imagine, during the pandemic, it's been their perfect excuse to delay everything. So as you can imagine, we have planning on sites that were due 3 months ago that we still don't have a decision from the local authority, and they give no guidance as to when they actually are going to give a decision. So the whole process on probably every project at every single stage has been hampered and delayed, and that's why it's very refreshing when you have lenders that are taking a pragmatic approach to all of this, because of course, if there was ever a requirement for pragmatism, it's been in the last 12 months more than ever before, and so the lenders that are really coming to the fore are the ones that are taking this approach. Unfortunately, there are still very many of Acre Lane's competitors who are not taking that same approach and are being very rigid and very inflexible for whatever reasons that may be. Maybe it's because of their funding lines and they don't have the same flexibility. Yeah, hopefully that answers your question.
Thank you, Kevin. James, just conscious of time, I'm coming to you for your final thoughts on the product and any sort of words of wisdom you'd like to share with those viewing as to best ways to use it or further advantages from your point of view.
Yeah, I mean, aside from the cost advantages that a lot of brokers will see as a result of the rates coming down in a lot of these products, there is obviously the advantage of giving your client a sales period of 12 months, allowing him to sell the properties at a price that he deems perhaps more fair than having to sort of take lowball offers and only having a 6-month sales period with his current lender. And so I think it's very much, with a lot of competitors in the market, a lot of rate compression for brokers now. It is a buyer's market. I think we can all take advantage of that, and yeah, a development exit product is another way to sort of get another deal over the line with your client.
Thank you, James. George, just would you like to leave us with any sort of parting comments on the topic, on the product, and how you perhaps see it evolving in the future?
I mean, look, I think for me, crucially, it's just important that clients, brokers, and lenders think ahead, plan ahead, and then act ahead. I think the earlier in the process you can engage with the exit, the better. It just makes things a little bit more orderly. And as I say, it also encourages you to have that commercial conversation with the clients in relation to the cost-benefit analysis of, is this a worthwhile thing to do? Sometimes you have to do it because, as we've talked about earlier, some lenders are inflexible and they won't extend. But it is that cost-benefit analysis of, do I give myself that extended period of time to maximise my returns versus the cost of the product itself? And that for me is always going to be the core elements of one's consideration with that.
Thank you very much, George. Chris, final thoughts from you, please.
Yeah, I see this being probably one of the principal products that we'll be dealing with in the next 6 to 9 months, if only because there are so many lenders who don't seem willing to extend, and there are so many sites that are behind. I think from a lending point of view, this is going to be front and center.
Look forward to your role that you play in that, and I think definitely we will be tackling this reticence, although it doesn't really play in your favor for us to address lenders unwilling to extend, but I think that's something we do need to talk about more widely. And Ian, finally coming to you for your thoughts.
Yeah, just to echo Chris's comments, totally agree. The one thing I would add is, I think we've structured and intermediaries have requested typically development finance loans where there might be a 12-month, 18-month, 24-month build, and then a period for sales, call that 6 months. I think that there is no reason that I can think of why you structure a deal with 12 months, 18 months, or 24 months build, and then a development exit already embedded for the sales period. Why not give them the extra cash slug or reduce their rate at the end of the build period? It's a free option basically for developers to essentially reduce or either get more cash up front or reduce their interest rate, or both.
Thanks very much, Ian. I think we've just gone 12 o'clock. That sort of wraps us up. I think that was a very in-depth products in action type conversation, which is exactly what we're trying to achieve with these sessions. So thank you very much for your support, Chris and Ian from Acre Lane. Thank you. And to George, Kevin and James, thank you for joining us and for sharing your thoughts. To the people that have tuned in, thank you. We will be publishing this video sometime next week with a short highlights piece in case you miss it or you'd like to share it. But yes, and we will sort of see everyone here same time next week. But thank you very much, and have a wonderful rest of your day.